Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, February 5, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And as you all know by now, we had quite the meltdown today. Pretty incredible day out here in the markets. A day that we just don't see that often, if at all. This may be the single most or worst day that we've seen either in quite some time or if at all. So we had the S&P 500 down 113 points or over 4% today. The Dow is down over 1,100 points, 1,175 points on close, 4.6%. It was an absolute bloodbath, as we know. We obviously cut through my 267.40 level like a hot knife through butter. It was pretty incredible out there today. So this level becomes a non-issue any longer. So we did come in just short of the 100 period moving average. That level comes in at 262.96. The low today happens to be 263.31. There's likely more downside coming. Let me explain the phenomena, what happened today, as far as I can see it. So basically, think of it like a rubber band. You stretch a rubber band, you stretch it, you stretch it, and one of two things happens. It either snaps back because you let go of one end, and that's when the market is way oversold or overbought on the upside, as we were in January, way oversold today, and either it's going to snap back or it breaks. And today it broke, and we just don't see it that often. We saw a day like this in 2011. We saw a flash crash that snapped right back in 2010. And we obviously saw some days like this in 2008. But this one was one for the books, no question about it. This was a day where if you're an intraday trader, you step aside. You don't mess with a market like this because you really don't know how far it can go on the downside. I always say this, markets can go a lot farther on the upside and a lot farther on the downside than most people think they can. Here are some important levels on the downside. There's one below us at 260.25. In fact, the futures, after the market closed, the futures actually went down to about that level anyway. So we could expect to see that level tested tomorrow unless something happens overnight that would reverse these markets. It's possible, it's just not probable. The likely scenario is we're going to see the global markets in Asia and then Europe be selling off when everybody wakes up in the morning. The likely story is you're going to see the global markets respond to this, and then there's probably going to be more selling in the morning session. In a market like this, we don't try and catch a falling knife. What we have to do is we have to, just like we were waiting on the upside, we're waiting for a signal of a trend change or a reversal signal. We don't want to catch the falling knife. It could come at 260. I actually doubt it does. It's probably lower. This market may want to get all the way down to the 200 period moving average at 253.14. That's where it comes in right now. I'm not saying it will, but it certainly could. After a day like this, anything is possible. Selling begets selling. And when there's forced liquidation, which apparently happened today, the selling just gets worse and worse and worse. And then you have the people that were the last ones in on the way up. They thought the market was going to go up forever. And we talk about this all the time. It just doesn't work like that. The market was way overbought, but it's going to go up until it doesn't. We had a reversal on Friday, or we didn't have a reversal, but we had a hard sell on Friday. And when people wake up and they see that stocks that they bought, for example, all of a sudden they're down 5%, 10%. Next scene shows they're down 20% from 2 weeks ago. They just throw it out with the bathwater, and selling begets selling. And that's pretty much what happened today. You had forced selling. You had retail traders selling. You had investors saying, get me out. You had forced liquidations of hedge funds, margin calls. You had the whole kit and caboodle today. What I will tell you is, if this market does not stop at the 100 period moving average, which this market hasn't seen since last August, the blue circle on the left side of your screen is the last time this market saw, the SPY or the S&P 500 saw its 100-day moving average. We came close today. We didn't quite hit it. Expect it to be hit at minimum. But generally speaking, you would normally see a bounce off the 100-period moving average. If we cut through the 100-period moving average and close below that level, that's going to be an extremely negative sign. Let's wait and see what happens. Don't try and catch the falling knife. This is a time to be cautious in the markets. There will be a reversal, but you don't have to be the first one in. There's going to be one heck of a rally to the upside once we find the bottom, but you don't want to be the first one to try and pick the bottom because it generally doesn't work. It's the same discussion as the market was going up each and every day, week after week after week. I said, don't try and pick the top. It's not going to work. You have to wait for the market to tell you when it's finished going up. Well, obviously the market was finished going up. Now it's the same thing on the flip side. We have to wait for the market to let us know that a reversal is at hand. Intraday traders, you will see the reversal. You will see a signal of a trend change, the same ones that are taught in my course at lazyeMinitrader.com. You will see that happen intraday. You will see it on a 10-minute chart. You will see it on an hourly chart. 100% certain we will see an intraday reversal. We just don't have to guess on when that's coming. The lower level on the chart, this lower horizontal line at 246.31, that represents a 38.2% retracement from the 2016, January 2016 lows. That in and of itself is a normal garden variety retracement when markets find a top and begin to correct themselves. Think about this. We're nowhere near a 1/3 retracement of these markets just yet. That goes to show you the magnitude in which we went up, the fact that we had no pullbacks to speak of any magnitude whatsoever. This market is going to correct itself. It's obviously begun to correct itself. It's just a matter of, on this leg down, how far does it want to go? I'm not going to guess. I'm going to wait for the market to tell me when it's going to have a multi-day or multi-week bounce higher. You will see enormous swings in both directions. The volatility has absolutely exploded in this market. Here's your Russell 2000 index. The horizontal line comes in right below the 200-period moving average, right around 144.58. Make it 144.50 even. That represents this pivot low here, and that represents a pierce through of the 200-period moving average. That level on this move is likely to be tagged. It's also likely to find support in this market. It's only $3 lower in the IWM, and to put it in perspective, we came down almost $8 today, or 5% in the Russell 2000 index. Just to put a day like this in perspective, and those of you that are traders intraday and have trading platforms may or may not have experienced the same thing, but I can tell you, I use TradeStation, and I've never experienced this before in many, many years using this platform. TradeStation could not catch up with the market. The quotes seemed to be off. The bid-ask spreads were whacked out. When I went to change a chart from one time frame or one symbol to another, it took a long time to load. So TradeStation, in and of itself, their servers, their platform was slowed down. They were having issues. And when you see something like that, you know things are bad and you stay away from the market. You don't try and pick bottoms. You don't need to be a hero. You have to be able to come back and fight another day with your trading and investing capital. Here's a chart of the VIX, the volatility index. This is an absolute explosion in volatility that we haven't seen since 2008. It was an absolute explosion to the upside. In fact, the volatility index, if you look at some of the ETFs, or I should say exchange-traded products, they're not funds, they're exchange-traded notes. And when you look at some of those in the after-hours session, they've even exploded higher. Here's the weekly chart. As you can see, remember, we like to buy the VIX below 10, certainly around 9. Look where we are, 37.32 on close today. When you look at the monthly chart, you can see the magnitude of where we are. This is an absolute explosion of volatility. It won't stay like this forever. The market will have a bounce. the market will rally, it will have a snapback, and it will be fierce because there will be a ton of short covering. And the VIX, the volatility in and of itself, will get sucked down. It could get sucked down 20 points in one day. It will certainly happen. The question is it going to be from 40, 50, or 60? We just don't know. This is a market that is not for the faint of heart. By the way, back to the spider, I just wanted to point out the volume today. The volume today was about 294 million shares in the spider. Under normal conditions, that's capitulation volume. And it may be. We may wake up tomorrow and maybe today was a bottom. You never know. I don't think it is. I don't think that's where the probabilities are. Anything is possible. I just don't think it's probable. When you see a day like this, it's telling you one of two things. 294 million shares traded in the spider is either capitulation volume, meaning a bottom, or it's telling us there's a lot more downside coming. It's one of the two. We're going to find out sooner than later. I don't think it's a bottom. Generally speaking, we don't see markets finish at lows and mark a bottom. It's usually a gap down in the morning and some kind of reversal, and that's usually the way a bottom is formed. However, we'll see what happens going forward. It'll be interesting to see when we wake up tomorrow on Tuesday and the global markets are responding to our market on Monday, what happens when we open at 9:30 a.m. Eastern Standard Time. Going over to gold for a moment. So gold was up on the day, but it really wasn't up all that much. When the market was melting down, a lot of times you see people run into gold as one of the safe havens, but that didn't necessarily happen today. It was up a few dollars, but it really wasn't up all that much. And now as we begin what really is the session for Tuesday on the 6th of February, we're now above the 20-period moving average. We'll see what happens with gold tomorrow. Gold is still technically in an uptrend. There's really nothing technically wrong with the gold market until and unless we can close below 1330, which is the low from the 2nd of February. As long as we can stay on a daily chart closing above that level, then there's really nothing technically wrong with gold. If that fails, then we can start to see some downside in gold. But right now, technically nothing wrong with the gold market. Crude oil, crude got hit today, but all in all, everything got hit today. Everything got thrown out with the bathwater, so it shouldn't be unexpected that crude oil was down. All in all, it was really only down $1. We're looking at the red candle here. This little green candle is for Tuesday's session, the 6th of February. So it was only down $1. It's not that big of a deal. And frankly, again, nothing wrong with the uptrend in crude oil. We still could have higher prices coming in crude. When you look at the weekly chart, there's a possibility that we just go sideways for a few weeks, consolidate, build some energy to go through the 200-period moving average if that's what's going to happen, and that would reach the upside target of 73.78, where this would represent a very, very good shorting opportunity, also known as a stone cold short in crude oil at 73, 78, 74, in that neighborhood. Now I want to talk for a second about the bond market. What you're looking at here is the 10-year Treasury note interest rate. Now we talked about this last week, and you can see here that we had a nice ramp up in interest rates. Bond prices were going significantly lower. If I flip over to a bond price chart, so this is the actual price of bonds. This happens to be the 30-year bond, but the charts look the same. So you can see here that bonds were melting down, and today, this is the green candle is today's activity. Okay, and so when you see this, you can see that bonds began to spike up. However, they sold off. What was interesting is on a day when the market was melting down, the stock market was melting down, we didn't necessarily see a out of the ordinary spike higher in the price of bonds, meaning where was money going is the question. Usually, money's going to leave the stock market and rush into the bond market for safety. That's not what we saw today. We certainly saw an uptick in bonds, but not to the magnitude in relation to how far the stock market was down. I find it interesting. It'll be interesting to see how the next few days unfold, because I'm here to tell you, if bond prices sell off at the same time stocks are selling off, and I've talked about this before in the past, that's where money has nowhere to hide. And that's what crashes are made of. I'm not suggesting we're going to see that right now. I'm just saying watch out for, if you see the bond market melting down at the same time stock prices are melting down, put money under your mattress because there's nowhere to hide. Not here to scare anybody. I think it's a garden variety meltdown so far. I wouldn't exactly call it a crash. They're going to talk about it as a crash on TV. It's a one-day crash, absolutely. However, keep in mind, we're back on the spider chart. I brought up a weekly chart. We're only 8% off the all-time highs. Now, I don't want to minimize 8% because it happened in only a few days. But the reality is when you're down 8% from all-time highs, that's not a crash. The market needs to correct itself. We've been talking about this for a long, long time. We didn't want to necessarily have it happen in a span of a couple of days, obviously. However, here we are. This is what we have in front of us, and we have to deal with the reality of what's going on. And what's going on is the market's down 8% in a few days, but it's still only 8% from all-time highs. If we came down all the way to the second horizontal line at 246.31, that would be a 38.2% retracement, which is a garden variety retracement from the January 2016 lows. That was going to happen one way or the other. Didn't necessarily have to happen in a couple of days, but that was always going to happen. It was just a matter of from what price. Now we know. We'll have more information over the coming days. We'll take it one day at a time. But with that, it's everything that I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis. Stay safe out there in the markets.